Hello everybody. At this time we are talking about concepts of cost accounting. Cost accounting is a method of accounting that is used to track, analyze, and report on the costs associated with running a business. It is an important aspect of financial management that is used to make informed decisions about how to allocate resources, set prices, and manage expenses. The purpose of cost accounting is to provide managers with detailed information about the cost of products, services, and projects so that they can make informed decisions about how to operate the business in the most efficient and profitable way. And then we move to the different types of costs. The first, direct costs, are costs that can be directly traced to a specific product, service, or project. Examples include raw materials, labor, and direct overhead. These costs are essential for determining the cost of goods sold and are used in pricing decisions. Second, indirect costs, also known as overhead costs, are costs that cannot be directly traced to a specific product, service, or projects. Examples include rent, utilities, and administrative expenses. These costs are necessary for running the business, but they are not directly related to the production of a specific product or service. And then third, fixed costs are costs that do not change with the level of production or sales. Examples include rent, salaries, and insurance. These costs must be covered regardless of the level of production or sales. And then fourth, variable costs are costs that change with the level of production or sales. Examples include raw materials, direct labor, and commission. These costs fluctuate with the level of production or sales. And then fifth, sunk costs are costs that have already been incurred and cannot be recovered. Examples include the cost of equipment that is no longer in use or the cost of a tailored product development project. These costs should not be considered when making future business decisions. And then six, opportunity costs are the benefits that are given up by not pursuing a certain course of action. These costs represent the potential benefits that could have been gained if a different decision had been made. And then we move to concept of cost accounting. Cost accounting is an independent branch of accounting that identifies, records, analyzes, and controls the costs related to the production of goods or services. The ultimate objective is to identify production costs, study behavior, and provide relevant cost information for sound decisions, control costs, and measure performance in a proper manner. While financial accounting gives outsiders a comprehensive view of the financial position of a company, cost accounting is mainly used for internal management and for the improvements of operational efficiency. It gives the business all it needs to know regarding the numerous cost elements involved and how to manage, such as reducing or decreasing expenses to maximize profitability. Cost accounting is defined as the systematic identification, evaluation, and regulation of expenses in order to increase business efficiency and profitability. It is a key tool for internal decision making, assisting firms in setting competitive prices, managing operational expenses, and optimizing resource distribution. Cost accounting gives a thorough understanding of cost behavior and structure, enabling strategic planning, cost cutting measures, and long term growth. And then we move to objectives of cost accounting. The first, cost as ascertainment. To determine the actual cost of producing a product or service accurately. This includes identifying both variable and fixed costs associated with production. Second, decision support to provide management with relevant cost data for making informed decisions such as make or buy decisions, product discontinuation, and pricing strategies. And then the third, cost control. To control and reduce unnecessary costs while optimizing resource allocation. This helps in improving efficiency and profitability. Fourth, performance evaluation. To assess the performance of various departments, products, or projects within the organization. Fifth, cost reduction. To identify cost reduction opportunities by analyzing cost variances and making necessary adjustments. And then we move to key components of cost accounting. The first component, cost classification. Costs are classified depending on their nature, behavior, and purpose. The main classifications into direct costs refer to production expenses, which include raw materials and labor, indirect costs or overheads, which include rents, utilities, and administrative costs. Fixed costs refer to those that are not affected by the level of production, such as rent, variable costs, which change depending on the amount of the production volume, such as raw materials, or lastly, semi-variable costs, which have both a fixed and a variable component, include utility bills. And then the second, cost analysis and reporting is one of the functions of cost accounting that generates complete reports to assist management in cost analysis, profitability evaluation, and strategic decision making. These reports usually include cost sheets, variance analysis, and break-even analysis. And then the third, cost accumulation is the systematic collections of cost information related to items, departments, or projects by tracking the expenses associated with materials, labor, and overhead. And then fourth, cost control and reduction is helped by cost accounting, as it will enable the monitoring of expenditures, identification of inefficiencies, and implementation of strategies to minimize waste and manage operating costs while maintaining quality standards. And fifth, cost allocation and proportioning involves assigning costs to specific products or divisions and distributing indirect expenses equitably among various products or departments. I think it is enough. Thanks for watching.